Hey everybody, we are live this Sunday on our Sunday live stream here on Let's Talk Money. I want to thank everybody for joining us each Sunday at 1 p.m. Eastern Time, 10 a.m. Pacific Time. Great chance just to reach out and connect with everyone in the community and see how everyone's doing and talk about an important topic for the week. So I want to get started real quick. I see some people are joining in. Welcome everybody. And today we got a really important topic for you because we're going to be talking about some financial ratios that I think every investor needs to know about. Needs to know what they are, how to use them, and really empower you to make your own investments and pick stocks if that's what you're looking to do. I see so many people just look for lists of stocks to invest in and pick here on YouTube, and that's fine, but if you're relying on someone else for your investments to pick your stocks, then you never know really what they're looking for or if it really applies to your situation. Well, I want to get started real quick, and again, thank you for everybody that's going to be here. And these financial ratios, I'm so excited to get started with these because this is exactly what I did working for venture capital firms and portfolio managers. So this is this is something I've done for a long time. One ratio investing strategy that I'm going to share is something that has shown to produce 30% annual returns. So it's a great strategy, and all 7 of these financial ratios are going to help you pick your own stocks. Are going to help you understand what equity analysts, what people on TV or here on YouTube are talking about when they talk about these ratios. We're going to start off with a few community shout outs, some comments that I get throughout the week that I want to highlight, some great comments that I received. I'm going to highlight a few of the videos that we had last week and then coming up, and then we're going to get right into those financial ratios, and we're going to leave time for some question and answer. Darnita, welcome. Actually, your comment is the first one I'm going to be highlighting. It was a great comment I received this week from Darnita. I really appreciate everyone that takes the time to give me feedback on the videos, share their own personal finance journey, what they're doing, and I get some great tips and great ideas every week. So we're going to be highlighting that. Matthew, Greg's been a great member of the community for a long time here. Always always shares what he's looking at and everything. Talat, hi from Michigan. So I want to get right into our comments, get right into the live stream because we've got a lot to talk about this week, and those financial ratios is something I've wanted to do for a long time. Like I said, that's where my professional background is, and I always love talking about these things. So we're going to hop right in, and like I said, the first comment we got that I want to highlight, something we got last week from Darnita, and she's investing in M1 Finance with her 12-year-old. And she's looking at some of those Vanguard pies and stuff. And then she also says that his birthday money and earned money she invests for him, and they're listening to the Rich Dad Poor Dad for teens this summer. And so much great stuff in here. I just had to highlight the comment. One, using that M1 Finance platform. It's what I'm using for our 2019 stock market challenge. No fee investing, no cost investing. So it's a great platform to use. And what I like about it is you can put money into it every month. That gets automatically put into the stocks in the percentages that you want in each stock or fund or whatever, and it's never a cost to you. So it's a great opportunity there. I love that she's getting him started at 12 years old. I wish my parents had gotten started when I was 12. Just so much opportunity for that compounding interest, and that kid's going to be a millionaire. By the time he's like 30 or 40, easily going to be a millionaire. What I also liked about this and why I wanted to highlight it was she's involving him in learning about investing, learning about personal finance. And I think that's so important to engage with your kids and bring them in on it. And they're sharing it. They're doing it together. They're listening to that Rich Dad Poor Dad for teens over the summer, and it's a great way to connect with your kids. Plus, get them started right, because we learn so many bad money decisions from our parents. It's great to see when somebody can be sharing something positive with their kid and learning together and really sharing that experience. So I had to highlight that comment. Great comment there. Our next one is from from Passive Income Tom. So another member of the community here wanted to give a shout out to Tom and his channel. He actually talks about passive income ideas and stuff on his channel. But he had a great question here, talking about having cash available in your stock account for the stock market decline. And this is a big question I've gotten lately on the channel is, we started May out with warning about that stock market crash. I told you why I was rebalancing some of the stuff in our stock market challenge portfolio, moving away from some of those high flying stocks that have performed well, and into some bonds and utility stocks, some safety sectors. And we close out May with a 7% decline in the in the S&P 500. Not quite a stock market crash yet, not quite a correction, but it's far from over. A lot of the things we're seeing, especially these new tariffs that might be placed on Mexico, as well as the ones on China and maybe coming up in the China trade deal, there's no bottom in sight for this. So, a lot of investors have been asking me how to invest ahead of a potential stock market crash. What should they be doing now? How much cash should they be holding? And it's something we've talked about. Personally, I'm rebalance. You should always make sure you're rebalancing your portfolio ahead of something like this. So you go back and look at, okay, how much do I have in stocks? How much do I have in bonds? And how much do I have in real estate? All right, those are your three main asset classes that you can easily get with funds and REITs there on any investing platform. So, it's a good idea to go in there and say, okay, you know what, after 10 years, stocks have boomed. I haven't really done much with bonds or real estate, and now I've got like 90% of my money in stocks, which obviously is, for any investor, even younger investors, you want that mix of stocks, bonds, and real estate. So it's a great opportunity to go in, maybe take some money out of those stocks, put it back in bonds, put it back in those REITs, those real estate funds, and that just shields you a little bit from that stock market decline. As well as having a little bit extra cash. I don't love having a lot of money sitting aside in cash because it doesn't make you any money while it's sitting there. But personally, I'm about 10% in cash right now. So I don't think there's anything wrong with having a little bit extra in cash, 5-10% maybe, and and just waiting to see how things develop over the summer and as we get into that winter, which is usually a little bit better time for stocks anyway. So a great question from Passive Income Tom wanted to highlight that, point that out. Our third comment here is just wanted to highlight Don's comment. Talked to Don this week actually as part of a free portfolio review that I do for everyone in my investing course. Don told me he's a fellow Marine, so hoorah there, Semper Fi Don. He's been in and out of the market since the 60s. Kind of shared his experience with a lot of the stock market bubbles and the crashes that he's lived through, and and how it's kind of left him, in not trusting stocks too much. So he signed up for the course, and we went through his portfolio a little bit, and talked through the sector spreadsheet that I shared with him, and he's doing pretty well. He's actually 75, so he's looking at pretty risk-free future for him as far as creating that income and making sure his investments last. But I'll share a link to the course in the video description below. I actually offer a free webinar to describe that goals-based investing strategy that I use and that I developed working with portfolio managers and working with private wealth. And then actually a YouTube discount for anybody that wants to try the course out. It's a 45% discount. I'll leave that in the comments below as well. And of course, like I said, that comes with a portfolio review. We get on the phone or through email and look over your portfolio. But I want to get back to our live stream here and look at some of those videos last week, the ones coming up this week, and then I want to get into those ratios because that's some very important ratios that we're going to be talking about that every investor needs to at least be aware of these and understand what people are talking about when they talk about them, because you see so much on YouTube, on TV, on blogs. People will talk about these ratios, they'll throw them around as far as how to pick a stock and why, but if you have no idea what they're talking about, then you're really at the mercy of of the research that they're actually doing, and some of the guys here on YouTube that I follow and that are great for actually doing the analysis. But then again, you see some guys that they're basically just regurgitating whatever they hear on CNBC. So it's not a great investing strategy. So I want to get you to those ratios that can help make you a better investor, help make you help you make better investing decisions. So last week we had some great personal finance videos. Really went to more to that beating debt side of the story that we like to cover. Had a student debt video that if anybody that has student debt, I urge you, please go back and watch that. We covered the 7 government repayment plans for student debt. So you've got your income-based ones, your standard ones, your extended ones that maybe give you a little bit more time to pay off your student debt. Very important to understand these, understand how to use some of these different programs maybe to free up a little bit of cash to actually be doing something with your money right now instead of having it all go to student loans, because that's I think the tragedy right now is that so many, especially millennials, are coming up with tens of thousands of debt. Just picking that standard repayment plan for student loans because it's the default, it's the standard plan, and they've got no money to do anything else. They've got fairly low student loan rates on their debt, but they've got no money to maybe buy a house, to invest in a business, things like that. So check that video out. Next week's videos, we're going back to dividends. We're going back to investing, and I love it. Obviously, equity analyst myself, so I love getting back to the investing side of the channel here. We've got 2 dividend videos on Monday and Friday, talking about the dividend yield, the dividend payout ratio, how to interpret those, and some risks when you're looking at those, as well as some investing strategies around them. So don't miss that. Wednesday is a portfolio update. Every month we get back to our 2019 stock market challenge portfolio and see how that's been doing, and discuss a topic around it. And this Wednesday I'm really excited about this one because not only is our portfolio still beating the market, our dividend stock portfolio on M1 Finance, we've got is 17. I just checked the stats after yesterday's close, or after Friday's close. It's 17, a little over 17%, 17.8% I think so far for the year. That's against a 9.8% increase on the S&P 500. So still doing very well, about an 8% return over the stock market. But what I like about it is, like I said, we started off May talking about how we were repositioning that portfolio and going from a little bit of risk into safety ahead of what could be a tough month. And we had a tough month, 7% down on the S&P 500. It was the worst May since, I want to say, 2012, and the worst month since I think last December. So a tough month for the stock market. Our stock portfolio, actually, it did fall a couple of percent, but it fell, I think, about 2.5% versus that 7% on the stock market. So very happy about that. Also talking about 5 strategies that you can use to survive a stock market crash. So we're going to be talking through 5 strategies on how to balance your position, how to balance your portfolio, reposition, different strategies. So when the stock market crash does come, and I'm not saying it's going to, but all signs are pointing to at least a correction in the stock market, and maybe even touching those December lows that we saw. So gonna get you ready and positioned and able to survive that at least, rather than kind of take what comes. But now I want to get started on these financial ratios, the topic for the week. And again, I'm excited to get into these because this is what I did for those venture capital firms, for portfolio managers that I worked for when I worked as an equity analyst, and really digging into the financials. Okay, because you can use the what the pundits are saying all day on CNBC and on blogs and on YouTube, but if you don't understand the financials behind a company and really some of these ratios that we'll talk about, it really it takes the power out of your hands when it comes to investing. So we're going to get into these, and while you're looking at these, I want you to remember 2 things. 2 things are critical, key when you look at these financial ratios that we'll talk about. First is that you always have to compare ratios or finances, so things like that, for companies within the same industry. Okay, and what I'm saying here is there's there's sectors of the economy the utilities, tech, consumer staples, consumer discretionary. These are broad sectors of the economy, right? And there's about 9 of those. Depending on how you mix them up, you separate telecom from some stuff or internet services. But you take these sectors, and within each of these sectors, so utilities is obviously a very defined sector of the economy. When you look into that, then they have different industries, and industries are things with companies that sell a similar product. Okay, so within utilities, you've got gas and electric, you've got water, you've got separate industries within utilities. Within tech, you've got hardware, you've got software, you've got internet services. So even within these sectors, the industries can be very different as far as what kind of product they sell and kind of the market forces and economics behind those. Well, now what I mean when I say always compare ratios for companies within the same industry is that, okay, you take something very simple like a payout ratio, right? And we'll talk about the payout ratio, very important for dividend investors. But the payout ratio is just, the percentage of profits a company pays out to cover its dividend. Okay, and obviously, when we're talking about payout ratio, the other side of that is the money that they keep back for growth, to grow the company. If you look at the payout ratio in the utility sector, utilities very stable. Most of them are regulated and near monopolies on their on their regions. So it's a very safe industry, very safe company or business model to be in. Cash flows are very easily forecast. They know how much money they're bringing in, and they know how much money they can take out. The debt is very easy to come by, very cheap in the utilities sector and within those industries in there. So they can afford to pay out a lot of that profit as dividends, upwards of 70, 80% sometimes for a utility company. And that's no problem. When you get into the tech sector and maybe software, okay, these companies are continuously having to spend on research and development, finding new markets, competing with other companies in their sector and in their industry. So it is very much, cash flow is very much more uncertain. Debt is very much more expensive because of that uncertainty in cash flow, and so they can't afford to pay out all their money in dividends, if they even offer a dividend at all. But the payout ratio is going to be much lower. Well, so if you're just looking at the payout ratio among all stocks, you go to a company, you see, wow, 80% payout ratio, they really have a commitment to the dividend. I'm going to invest in this company rather than the 35% payout ratio in this company, which happens to be a tech stock. It's apples to oranges. You can't compare that payout ratio for utilities with the payout ratio from a tech company and say, okay, this one's better than this one, because the market dynamics are so disparate. So we'll look at each of these financial ratios, but I want you to understand and always be comparing ratios and companies from the same industry. This is going to go for your PE ratio, operating margin, which we'll look at, debt to equity. All of these, you have to compare them within the same industry. So utility companies to utility companies, hardware companies, every consumer staples, food packaging to food packaging companies, things like that. I also want you to get into the habit of, when you're looking at these, try to understand the why that each of these ratios is different for companies when you're comparing them. Okay, why is the PE for one company higher than the other? Why is the operating margin for one company higher than the other? And it gets you away from just making that knee-jerk reaction. I think a lot of people look at, say, the PE ratio, the price to earnings ratio. And even if you're looking at within this same industry, so you're comparing apples to apples within the same industry, maybe a tech services company, okay, and you see, okay, well, this PE ratio is very high for this stock and it's lower for this stock. I'm going to go for this other stock, this lower stock, because it's cheaper, right, quote unquote cheaper on this price to earnings ratio. Well, just making that knee-jerk reaction, you don't know why the price to earnings ratio for this other stock is higher. Maybe it's higher growth, it's higher earnings growth. Maybe they've got a distinct competitive advantage over this other company in their market that makes their cash flows more predictable, makes it a safer and stronger company. So you really have to, when you're looking at these financial ratios, And I know it's a lot to ask. It's a lot of work, but this is what equity analysts do all day, every day. Okay, we look at these and we look at these ratios, and we don't just say, okay, well, this price to earnings is lower, this stock is cheaper, I'm going to invest in this. We go, no, okay, this company has a competitive advantage. Its price to earnings ratio maybe 10% more than this company, but that competitive advantage is something that's going to carry that earnings growth on into the future, and this is actually a better stock to invest in. So two things I want you to remember, want you to watch for while we're talking about these 7 financial ratios. Okay, so the first one is just typical price to earnings multiple ratios. Now these, and this is something that we talk about a lot on the channel here, is be suspicious of earnings ratios. Be suspicious of earnings, period. Okay, and what I'm talking about is, the company reports 3 financial statements each quarter. It reports its income statement, which is that traditional, revenue, what it sold, all its expenses, its income, that kind of thing. That's the earnings, income, and then it has your balance sheet and your cash flow statement, right? Well, what most investors don't understand is there are so many ways to fudge the numbers on the income statement. Okay, you can take sales that maybe not quite delivered until sometime in the future, but you've got some kind of a contract. You can take those early to make your revenue stand out. You can capitalize some of your expenses. Say that we're paying for this now, but we're going to use the benefit of this service that we're paying for over months or years. So we're not taking all of that expense now. So of course that's going to lower the expenses and increase the earnings. So all kinds of ways for companies to make their earnings look better than maybe they actually are. So that price to earnings ratio that everybody likes to talk about, everybody loves following because it's so simple. You got to be suspicious of that, right? And sometimes you might want to look at some of these other price or multiples instead. So you've got your price to earnings, which is easy. It's just the price of the stock divided by the earnings that the company reports, earnings per share, right? But then you've got some other ones that are maybe a little bit better, higher quality ratios. If you're looking at these multiples, these price multiples, right? So price to sales. Still some ways to fudge your sales numbers, but not quite as many ways as it is for your earnings. Price to cash flows. I like price to cash flows, and most equity analysts use price to cash flows instead. And we'll talk about the cash flow statement. But because cash flow, you got the statement of cash flows, and that is actual cash coming in and out of the company, right? So this isn't accounting gimmicks or shenanigans there. This is actual cash coming in and out of the company. So if you take your say your cash flow from operations, which is the purest measure of that cash generated by the company, and you compare the price to that. So if you've got cash flows just on a company-wide basis, so your cash flow from operations, not necessarily cash flow per share, then you can do one of two things. You can take your market cap of the stock, which is the market capitalization is just the price of each share times the number of shares outstanding. Okay, so that in effect is all your per share prices, right? So you take your market cap divided by the cash flows from operations to get that price to cash flows ratio, or you can take the your cash flows and how many shares are outstanding. So you divide cash flows by shares for cash flows per share, and then just do price of the stock divided by cash flows per share. Another good metric is the price to book value, and this is the book value of their balance sheet assets. And especially if you're looking at a finance company, so banks, insurance companies, this is where that price to book value is very much a higher quality ratio than that price to earnings, right? Because banks, insurance companies, most of their assets are financial assets on the balance sheet. So it becomes very much more important to look at that book value and the price to book value when you're comparing these across to each other. Let's look at the next one, enterprise value. This is a favorite of mine, and it's a favorite of most private equity and venture capital analysts and a lot of other equity analysts, just because it gives you a truer picture than market cap of what the company is worth, and you use that to compare with a lot of different metrics. So the enterprise value is just the market capitalization, and we talked about that. That's just the price, the stock price times how many shares how many shares are outstanding. So the total stock market value of that company. and then you minus out balance sheet cash. So you go to your balance sheet. Right up there at the top, the very top of every balance sheet is the cash that they have on hand. You take that out and you add in long-term debt. Now what this is this is the business value of a company, okay? Anytime you hear of an acquisition that happened or a merger, they're going to be talking about the enterprise value, okay? Because that's the market cap, so the stock market value of the company minus balance sheet cash, because cash, you take cash out because that's it's an asset that you can easily liquidate or convert or whatever, and then you add in long-term debt. Because the thing is, you look at a lot of these companies and you look at the market cap alone, so the stock market value, but here they have hundreds of millions or billions of dollars in debt. If somebody's looking to actually invest in that company, buy that company in an acquisition or merge with that company, the true company value of that stock is much different because they have all this debt. The company is worth less because of this debt. So what you want to do, you want to do that. You want to find the enterprise value, and a lot of times, a lot of investing platforms or Yahoo Finance, it'll show you the enterprise value, and then you use that in your price multiples. Okay, so you do a price to enterprise value multiple instead of maybe price to earnings or price to cash flow, and this just gives you a higher quality picture of the comparison for this company's value versus or price multiple versus another company's. Right? You get two companies in a sector, and maybe one has a very high amount of debt and one has very little debt. So if you're just looking at the market cap, price to earnings, price to cash flow, you're not going to be looking at this debt and the effect that has on the value of the company. So get familiar with the enterprise value. Start comparing your stocks as far as price to enterprise value, maybe instead of some of those other price multiples. The operating margin, okay, this is my favorite ratio by far right here, because this is a pure a pure ratio for the business profitability of a company. Okay, and for those of you who don't know, okay, so we talked about the three financial statements that a company reports, each quarter, each year, the balance sheet, the income statement, and the statement of cash flows. Okay, so you go to the income statement, and that is the sales, all the expenses, so the operating expenses, and then the earnings, right? Well, the operating margin, you take that operating income, which it'll show it, operating income, operating profits, and you divide that by the revenue, okay, by the sales, by that total revenue, total sales column. And what that's the business profitability, okay? That's the sales that they made minus how much it costs to buy all their inputs, so their cost of goods, minus all their operating expenses, so the expenses to run this company, and then that gives them their operating profits. Now, so this is before any effect of debt or tax effects. A lot of under that operating profits, they'll take out the interest payments, they'll take out taxes, whatever their taxes was, or tax breaks that they got. And what you get with a lot of those interest payments or the debt that they use, that's financial leverage. So not necessarily how management is running the company. And then with the tax effects, there's all kinds of screwy accounting things that you can do with taxes to make your earnings look better. So this operating margin, or this operating income divided by revenue, that's your operating margin percentage, your profitability percentage of the company. That's just a true measure of the management's effectiveness at running this company, how they turn sales into operating profits. Okay, so an excellent way to compare your stocks within those industries. And what I like about this the most is really, it leads you into which companies have a competitive advantage. Okay, which companies are able to get the most profit out of their business, the most profit out of their sales. Okay, and so you look at the companies that have that highest profit percentage, that highest operating margin. And we start to question why. Why are they at 20% when the industry average is only 15 or 12%? Another important point that you want to look at. You want to look at industry averages for a lot of these ratios as well when you're looking at individual stocks. If one company is at a 20% profit margin, the industry is at maybe 15 or 12%. I mean, that's a pretty sizable difference. And if it's something that they've been able to maintain over a longer period, that is a strong advantage, and they're obviously doing something right. So you look at that, you find your best of breed companies, and it's a great way to separate the good stocks from the bad. Our next one, again, like we said, we'll talk about payout ratio. Extremely important for dividend investors, not to just run after those highest yields, those highest paying dividend stocks. You got to look at that payout ratio too. Because too little and it's not much of a dividend stock, right? If they're not paying out very much as a dividend out of their profits. Too much though, and it's going to seriously limit the total returns and gains of that stock. Actually, I just did a video this week on high yield stocks. Okay, so I went through Morningstar, looked at stocks over 6% yield. Some of the highest dividend payers I could find, and then picked out my favorite 5 and ranked them and everything. So that one's coming up in a couple of weeks. But what I found, and what was surprising, is that we had stocks from 6% from the low margin up to 15% that I looked at as far as total returns over the last 3 years, competitive advantages, things like that. And the top stocks for total return were not the highest yield. Okay, the top stocks were, there was a couple of them that had 6.2 and one 6.8% that produced 30% total returns or annualized return over those 3 years. So, almost doubling your money in 3 years on a stock that's, a really nice dividend yield at 6%, but still not that high dividend yield. And the way you do that, find some of those stocks, is that payout ratio. Okay, and this is going to be the annual dividend amount. So those 4 quarters of dividends. Remember, dividends are paid 4 times a year for most companies, each quarter. So you take the single dividend paid and times that by 4. So the annual dividend amount divided by earnings per share. Okay, so this gives you the percentage paid out each year by that company, percentage of their earnings paid out to cover the dividend. And again, too little and it's not much of a dividend stock. If they're never really committed to that dividend payment, maybe they're paying out 15-20%, while the rest of the companies in their industry are paying out 30 or 40%. And obviously that company isn't committed to their dividend. Okay, they might be offering a dividend. It might actually even be a very high dividend amount, but it's not much of a yield because maybe that company's a little bit larger. So you want to look for a dividend. If you're looking at dividend stocks and you want a company that's committed to their dividend payment, then yeah, look for a dividend payout ratio that's a little bit above the industry average, right? But what you also want to look for is you don't want it too high because a company paying out all its money towards dividends isn't going to have enough to research, to stay in competitive in those markets. And what you're going to find is, at best, the stock price just stays flat. Okay, so you get that dividend, that's great, but you get no price appreciation on your stock. At worst case scenario on that is, if they're falling behind in competition in their industry, then the stock price is going to be falling because their competitors, their peers, are going to be eating their lunch. So you want a payout ratio that's right in that sweet spot, maybe a little bit above the industry average. But you also, obviously, you want to look in there. You want to make sure that this is sustainable. This company has that competitive advantage. They can pay out a little bit more in their dividend and still stay competitive. And again, very important. Different industries are going to have a different safety payout ratio. Okay, like we talked about in the introduction there, you got to look at specific industries to compare stocks. Utilities going to have a much higher safety payout ratio. They can pay out much more versus stocks in the tech industry, so hardware, software, internet services, things like that. Our next one here is debt to equity, another very common ratio that that's just the total liabilities divided by shareholders' equity. So again, this one you're going to go to the balance sheet. So that balance sheet shows kind of their cash position, their assets, liabilities, and stockholders' equity as of that moment in time when they report. And you're going to go down, they're going to have total liabilities as a line item, and they're going to have shareholders' equity as a line item, right? So debt to equity, your debt to equity ratio is just the amount of the company that is really indebted. How much of the company is owed in debt. Okay, too much obviously leads to distress, and not only that, you not only want to look at like the interest payments and whether the company can actually make those payments, but just too much debt, it could be could mean a lower credit rating, which is going to mean higher interest rates for that debt that they're rolling over and that stuff like that, and a higher interest expense. But we go to the other side of that, and too little debt to equity compared to a lot of the other companies in their sector or in their industry might mean that the management just isn't taking advantage of that financial leverage. I know a lot of us in our personal lives, in our personal finances, we hate debt. We want to shun debt, pay it off, and just not have anything to do with it. In business, it's different. I would argue in your personal finances, it's different as well, and that you should use debt as a tool. But in business, it's very much different. Apple has, and I haven't checked it in a couple of months, how much. How much cash they hold on the balance sheet. It's upwards of a couple $100 billion in cash, but they also have a few $100 billion in debt as well. So why not take that cash and pay off the debt? Well, because they're using debt as a financial tool, for that leverage. So do not shy away or avoid a company that's using debt. They have to use it responsibly. They have to use. So maybe you're looking for companies in that specific industry that have maybe a little bit lower debt to equity than the industry average. That's fine, but they are using debt for that leverage and to really boost their shareholders' equity there. Conversely, you can also use maybe only interest-bearing debt or long-term debt in this calculation. And actually, what I used to do when I was working for portfolio managers as an equity analyst, I just use the long-term debt, okay? Because within total liabilities, you've got a lot of the current liabilities, which are things like payroll that they still need to pay, or expenses that they still need to pay that aren't really debt. It's just current stuff that they have to do. So maybe you only use long-term debt divided by your shareholders' equity instead. But one thing you got to remember: stay consistent in your calculations. If you're going to be making the decision to only use long-term debt in your debt to equity calculation, do that for everyone. Okay, don't use long-term debt in one and then total liabilities in another, because obviously it's going to give you a very skewed representation of these two companies. Almost done here. Got a few more, and then I want to get to your questions because I see some good questions coming in. This next one is cash flow from operations versus earnings growth. Okay, so CFO growth versus earnings growth. Very important financial ratio to understand, to use for when you're looking for companies that are kind of cooking their books a little bit. And I won't necessarily say outright fraud or scams or lying on their books, but definitely some accounting shenanigans that a lot of companies use. And we actually covered this a few live streams ago. We looked a little bit deeper into some of these accounting shenanigans. But this is by far the best one to follow, is this cash flow from operations. So you're going to your statement of cash flows that a company is reporting. And again, this is the purest measure of that cash in and out of the company, right? How that business generates cash for its investors, okay? And the first segment is, and there is going to be cash flow from operations, right? The actual cash coming in and out of the business, not for investing, not for debt, but the cash flow from operations. So what you want to do is you want to take a measurement of that over the years. So maybe over the last 5 years, how much has cash flow from operations grown, right? And you find like an annualized number out of that, or even a total number. And then you go to your income statement. Okay, remember, income statement is the sales, all the revenue that a company made, all the expenses that it pays, its interest expenses, and its taxes, and then you get earnings, right? That net income, or that earnings per share that everybody hears about on the, in the financial media and all that. You want to do the same thing here. Okay, how much have their earnings grown, either earnings per share or total earnings? How much has that grown over that same period, over 5 years, annualized over 3 years, whatever? And then you compare them, okay? Because what this does is, remember, that cash flow from operations, that actual cash coming in and out of the company, is very hard to fudge, right? There's a few tricks that companies use, but by and large, it is a much truer picture of the cash coming in and out of that company. Whereas the income, the earnings, it's very easy to fudge, okay? There's lots of accounting tricks. Well, what this does is, if you've got a 10% growth annualized growth in cash flow, right? The company is growing the cash coming into the company, into the business, about 10% a year. But then you look at the earnings, and somehow they're reporting 30% earnings growth every year. Well, what's happening here? Okay, this is something. I mean, this is pretty much the biggest red flag. The first part I always looked for when I was analyzing a company, right? Is this red flag that earnings are growing so much faster than actual cash, right? Because ideally you would like them to match up pretty close. If a company is that cash coming in and out is what investors want. That you want that cash eventually for the true value of the shares. But if they're saying, hey, our earnings are awesome, our earnings are 30% a year, what are they doing to make those earnings so much better than cash is? Okay, because earnings are just accounting gimmick. Earnings are just accounting. It's all paper. Paper on the books, right? Cash is actually money in the bank. So definitely get familiar with this cash flow from operations growth versus earnings growth. Compare like a 3 or a 5-year annualized growth for each. And they're not going to be exactly the same. I think we looked at Apple a few weeks back when we were talking about this a little bit more, and even Apple, it's a little bit different, but only by a few percentage. I think the cash flow from operations was growing at maybe about 8% a year, and then the earnings growth was 10, 11% a year, so a little bit higher. Obviously, they're using some of the taxes and the leverage and different accounting gimmicks. I won't call them shenanigans, but gimmicks to make the earnings look a little bit better than actual cash. So 2 or 3, 4 or 5%, whatever, isn't bad, and it isn't bad if it's just 1 year or 2 years. But yeah, if you see that trend where earnings are growing much faster than actual cash flow, something's wrong. And you don't have to be a financial Sherlock Holmes. You don't have to find what actually they're doing, the scams they're trying to pull. Just generally just avoid the company. There's obviously something wrong there. Last one we'll cover before I get into your questions, and I want to get into your questions here because I see some great ones coming across the screen, is the net current asset value. And this one's straight from The Intelligent Investor, book by Benjamin Graham, one of the best, and not my quote from Warren Buffett, by far the best investing book ever written. So definitely check that out if you're looking to learn a little bit more about investing and how stocks work. But this net current asset value, okay, this is the current assets. So we're on the income, or we're on the balance sheet here. Okay, so one of those 3 financial statements that a company puts out, the balance sheet. Okay, that's going to be your assets, liabilities, what you owe, and the shareholders' equity. Okay, current assets, which is all the way at the very top of the balance sheet. You have cash, you have inventories, which is finished products waiting to be sold. You have receivables, which is stuff you've already sold to somebody, but maybe they haven't paid you yet. But you have a contract, they're paying you over 30 days or even a period of months. These are all current assets, so these are all things that are like cash, very close to cash. Your inventory can be sold quickly. Your receivables supposedly are coming in. Now, of course, companies can kind of fudge their receivables a little bit, make them look a little bit higher, and make them look like they have a little bit more assets on than they actually do. But this is a much higher quality picture of what the company has as far as cash right now and current cash. The other side of that is longer term assets, but below that, are going to be things like your plant, your equipment, maybe brand value, stuff like that. Acquisition, goodwill. When you buy another company and you buy it for more than its actual assets, which is generally the norm, then whatever you pay for it over what the actual assets are worth. So you're buying their plant, their equipment, their inventory, everything like that. If you're paying more than that's actually worth, then that's goodwill. And companies call it buying their competitive advantage, buying their brand, things like that. All these long-term assets, not quite as valuable as these current assets, right? They can't be converted to cash so quickly. And in fact, a lot of times you'll hear a company has to take a write-down, right? They overestimated their value of their assets. They have to take a write-down. Well, what they're doing is taking a write down in these long-term assets, right? And generally it's when they made those huge acquisitions, they paid so much for a company saying, hey, it's worth this much. Well, maybe it's not worth so much. So we have to write down, we have to decrease some of that value on those long-term assets. But back to this, sorry. I love talking about these financial accounting and all that equity analysis. But current assets, so you got your current assets minus your total liabilities, and where in your assets you're only taking the current assets. So only those assets that are very quickly converted to cash. You're taking all your liabilities, so everything the company owes. Okay, your long-term debt, your current liabilities, everything there. And the preferred shares. Now, a lot of companies don't have preferred shares, so you really don't have to worry too much about that. You just look in the stockholders' equity portion, see if they have preferred shares. So your current assets minus total liabilities and preferred shares, right? And this is going to give you a kind of a liquidation value of the company, right? Now you can do this on a per share basis or on a company-wide basis. So basically, net current asset value per share is just, and that's a typo. It's not dividend. It's divided. So you take that current asset value divided by the number of shares versus the stock price, right? And like I said, what this does is gives you a liquidation value of the company. So if back in the good old days of the 80s, the corporate raiders, which would just buy a company, break it up, and make billions of dollars, right? Then, it's that idea. If this company is, just the current assets are worth so much, you could go in, buy the company, and this is true for an investor. Basically, you are, there's no difference between, like a corporate raider and an investor in this perspective. You buy the company, you sell off the current assets for what you paid for it, or even a little bit less, and you've still got these long-term assets. So you've still got so many assets, so much value in this company beyond what you paid for it in this net current asset value. Okay, and this is something that, like I said, from that the Intelligent Investor book, Graham had a rule where he used to say, buy any company with 67% or less net current asset value compared to the stock price, right? So if you go in and these are pretty rare, so it's not like you're going to find these all over the place and make lots of money and that. These are pretty rare when this happens. But if you can find a company where its current assets are minus the total liabilities and preferred shares are like maybe 2/3 less, 80% less, something like that. So they're less than the actual price per share that you're paying. Then it's like a no-brainer, right? And actually, there was some research done on this that produces about a 30% annual return, and it was over like 13 years to 1985 that they did this research, and it was 30% annualized return because, like I said, you're buying a company. Basically, you're paying less than the current assets worth. Okay, if you're buying it for 67% or less of the net current asset value, you're buying it for less than the current asset value, but you're getting all these long-term assets and everything, all that as well. So an excellent financial ratio to watch for. What you do want to look for, though, in this is make sure that they're still able to keep that business running. Okay, I see a lot of companies that are selling for bargain basement prices. Well, it's because the company is dying. So no shit, it's gonna be a cheap stock because the company is dying. If you can find a net current asset value stock, though, that is selling for less than its net current asset value, and it's fairly healthy, it's the revenue keeps coming in, that's a buy. So I want to those are the 7 financial ratios that you have to follow. And I mean, like I said, I know this is a lot of work. This is a lot more work than just going to YouTube and getting a list of stocks to buy, going to CNBC and somebody leaning on a button that says buy, and rushing out and buying that stock. But this is the ratio. This is the analysis that you have to do if you want to do any better than just market returns. Okay, if you're happy with market returns, that's fine. Go out and buy a fund of the market or some of the sectors, and don't worry about any of this stuff. Do what you do best, make money, invest it, earn that market return. If you are picking individual stocks, though, you have to do some kind of analysis. Because there are millions of other people out there that are going to be doing it, and they're going to be eating your lunch if you're not. So spend a little bit of time, 7 easy ratios that you can look at for each stock you buy, compare those against other stocks in your sector, or in that same sector or that same industry, to pick out those best of breeds, the ones that actually have real potential to outperform and to make you a little bit more money than the general market. Okay, this is exactly what I did when I put together our 2019 stock market challenge portfolio. And look, 18%, 17.8% returns by the end of May, versus that 9.8% returns on the S&P 500. Okay, so almost double the S&P 500 returns so far for the year. S&P fell by 7% last month, and our stock market portfolio only fell by about 2.5%. So there is something to these financial ratios actually doing this analysis, and I want to give you the tools that you need to be able to do that. But I want to get into those questions. I want to answer your questions. If I didn't see your question, I'm going to scroll up and see if there were some questions here. But if I didn't get to it or I don't point it out, then go ahead and ask it again, because it gets hard to do the live stream and follow the chat. Again, I want to thank everybody for being here. I love reaching out and having this back and forth with the community every Sunday. It's a much more personal feel, I think, than the videos than we get to do on the videos. So thank you again for being here. Okay, so Greg asks, Greg's always got great questions. When might you use payout ratio based on FCF rather than EPS? Now, I wouldn't generally use free cash flow for the payout ratio. I mean, you can. It's kind of it's probably going to give you the same thing most of the time. What you do want to be careful for, though, is some of these different business structures. Okay, so if you're looking at dividend stocks, you've got your traditional companies, but then you've also got REITs, which are real estate investment trusts. You've got MLPs, which are master limited partnerships, and they get special tax breaks for paying out most of their earnings as dividends. So obviously they're going to be great dividend stocks, but they've also got lots and lots of capital. Capital equipment. They've got factories, real estate companies. They own real estate. So it ends up there's so much depreciation they take on their income statement that basically they've got very little earnings to account for, but they're paying out so much more in dividends. So using the payout ratio is completely pointless for these two types of companies, REITs and MLPs. And to your question, I would actually say, some companies, some other traditional companies, even if they've got a lot of capital equipment or a lot of depreciation. Basically, you can go on the statement of cash flows or the income statement, and you look for how much depreciation and amortization they're paying off, or they're marking on their books. And if that's a very large percentage of say their earnings or I guess their gross revenue, and you want to compare this across different industries to see, where's that limit line. I haven't actually looked at it, but there's going to be a point where, companies in the industry just have so much depreciation that it kind of skews their earnings. Okay, and this is what we're talking about. And you can use free cash flow, or you can use other cash measures to determine if that payout ratio is too high or too low. So really, to your question, it goes to the point of how much depreciation are they using to lower their earnings, okay? And is that skewing that payout ratio or that dividend divided by earnings ratio? And you kind of have to make your own judgment call on there. Definitely in REITs and MLPs, you have different metrics versus the payout ratio. You have your distributable cash flow ratios and things like that you use instead of the payout ratio. But even in traditional companies, if you see that a company has a ton of depreciation, then maybe you want to use free cash flow or some other metric for that payout ratio. So great question. E says, what do you think about Chinese stocks in a portfolio? Ctrip, JD, Alibaba, Sina. This is actually something I talked to Don in our call this last week. And I am a firm believer in Chinese stocks. Patriotic to my bones, but this century is going to go to China. They've got the economic growth. They are the second largest economy in the world, and forecast to outpace the U.S. in that total economic size within 20, 30 years at the most. So you cannot neglect, you cannot avoid Chinese stocks. And why I say that is a lot of investors, they say, well, I've got Apple or I've got Intel or other stocks with a lot of revenue from China. That's enough, right? That's U.S. domestic companies that sell in China. Well, obviously, it's not, as we've seen over the past couple of months, because as we speak, China is creating a blacklist list of companies, of foreign companies that are persona non grata anymore, right? And it's basically using it in those trade war negotiations, those that idea. China had a patriotic song or something went viral over the last few weeks about buying Chinese, kind of that buy American theme that we've had over the last 2 or 3 decades. Now it's buy China in China, and actually talking to a couple of analysts and friends of mine still in the industry, they're saying anymore in China it's almost a shame to pull out an iPhone because that is the American brand. That's it's almost unpatriotic, right? So there's definitely going to be a consumer backlash against a lot of these American companies selling in China. So you need that direct Chinese company exposure. And like we started off in the year, I put in the China Life, so the LFC ticker symbol. I put in the FXI, which is one of the Chinese funds of Chinese companies in our dividend stock portfolio. Because I think this is probably once in a generation play. Okay, years from now, you're going to look back and say 2018, 2019 was the year to put some of those Chinese stocks into your portfolio because they are trading at such depressed values, such depressed prices that you can pick them up fairly cheaply. And like I said, next 10, 20, 30 years, these companies are going to be growing much bigger and riding that economic boom that they're experiencing. I wouldn't be worried too much about being like an American investor investing in Chinese stocks and whether you're going to be shut out of the market or things like that. It's a communist country, but they still have those market reforms going on, and those companies need that capital that they get from the U.S. markets. So it's not something that they're going to be completely shut out and things like that. So I definitely think you want to get into some of these Chinese names. Shed, I see Shed's here. Great seeing you here. Shed's another great member of the community. Been with us for a long time and always always contributes his comments to the videos and everything. What else do we have here? Are bond ETFs good to be buying during the trade war? Long-term treasury, short-term treasury, inflation protects. So different bond ETFs. And actually, if you watched our May update for our stock market challenge, that's kind of what I did with a lot of our profits. I took profits out of a lot of our individual stocks, put them into a bond fund, which I believe I used the BLV, which is the Vanguard Bond Fund. I also like the AGG, which I think is the iShares bond fund, and actually another fund that I talked to Don over this last week in our portfolio review. And yeah, you can, instead of moving to cash, you can go to a lot of these bond funds, put your cash in there. You'd be earning, a 4% yield a year, which isn't bad. 4% total return usually is what it comes out to. And it's going to give you the opportunity to, when stocks do bottom out, then you can come back out of bonds and more into stocks and kind of rebalance there. So definitely great opportunity to be rebalancing your positions, your portfolio. Take some out of stocks, maybe a little bit, and make sure you have a good amount in bonds and even real estate funds. But yeah, I like the bond ETFs. And honestly, for anyone that has less than $100,000 to put in bonds, your best bet is going to be those ETFs, those funds, bond funds, because buying individual bonds, you need just to stay diversified. You need 12, 15 individual bonds. So different companies, different sectors, different industries, different maturities, things like that. And if you're just buying maybe 10 or 20,000 of them for your portfolio, then the costs, those expenses, brokerage commissions, things like that, just tend to be very high. So unless you've got 100,000 plus to put in bonds, then stick with the bond ETFs. Buy them pretty easy, just like stocks, and fairly low commissions. What else do we have? Best tax shelter on market net profit, including dividend profits. Uh, yeah, there's kind of a couple different questions here. I mean, one thing that I always recommend, okay, always one of the most basic pieces of investing advice you can get, and is really going to help your returns. Put your dividend stocks, your yielding stocks, so dividends, REITs, bonds, even put those in a retirement account, okay? Because you're not paying taxes every year on whatever you get into that account, right? You're not paying taxes on your dividends, your bond interest, things like that. In a regular taxable account, put your anything else, right? Your stocks that are going to be capital gains. So you're not really making much money on them until you sell them, and then that's going to be capital gains because you're not paying taxes on those until you sell them anyway. Your MLPs need to go in those, even though they're high yield. They have special tax circumstances where a lot of that dividend isn't actually taxed that year. So you want your MLPs in a taxable portfolio. Everything else up to the limit you can contribute each year, you put that in your retirement accounts. What else? So what other? Trying to look through. I appreciate everybody being here. I know I'm not giving shout outs and everybody, but I want to get to all the questions that I missed. How often should you reevaluate the ratios on the stocks you own? Great question. Because I see so many people. They stick with a losing stock, a company, that maybe the stock price starts coming down and maybe they even put more money into it and they stick with that company all the way down. It is very important to reevaluate your companies. You invested in them for a reason on this supposedly on a competitive advantage or lower priced earnings or whatever you did. But you got to make sure that doesn't change. You got to make sure that they don't lose their competitive advantage. I would say, you can do this. You can do this maybe once a year, maybe once every couple of years. Even it doesn't have to be. This isn't a month to month kind of thing, because preferably you're investing on those competitive advantage, those best of breed stocks, so that you're finding through these ratios. And those advantages, those don't change every month. Those don't even change every year. Okay, so you can probably wait, each year, kind of reevaluate your stocks. If they've gone too far off the reservation, then you reevaluate whether you want to hold them. And that's the same time that you're maybe rebalancing your portfolio. Okay, you look and see how your portfolio is done, how the stocks, bonds, and real estate is done. Whether maybe you want to take some profits and beef up your bond reserves or that position in real estate. So definitely not something you have to do every month or even every year. A lot of times. Now, I'd say if a company does take a big leg down, if the stock price falls quite a bit, then maybe you want to reevaluate it then. And I wouldn't say that's, and actually in a video we did a few months ago on 5 reasons to sell a stock, the stock price is not a reason to sell a stock. Okay, if a stock price comes down, there's a reason for that. But it's already baked into the stock, so you don't want to do that knee-jerk reaction where you just sell the stock because now you've already got that paper loss. You don't want to turn it into a real loss when maybe it's still a decent company and it's going to rebound over the next year or so. So but if a stock does come down, then you want to go in there. You want to look at, okay, does this change the way I feel about management? Has management really broken that trust, that confidence? Is there no accountability for it? Or is management just given free rein to do whatever it's doing and keep on doing it without any accountability? Those are the things you want to look for if you're to actually sell a stock. So you got to look for those. So if something does happen with a company, reevaluate it then off of your 1 year or 2 year schedule. Great question though. So what else we have? Secure credit cards. See if they're used at what point? At what point would it be wise to hire a personal financial advisor? And this is, Cody, it's a great question. This is kind of a personal, something personal decision you can make, and what type of investor you are. Okay. Now I will say, okay, financial advisors, especially the ones that help you with your insurance and other stuff, if they're if they're not trying to put you into expensive mutual funds, expensive insurance policies like the whole life or universal stuff that just cost way too much than they're worth, then some of them do a pretty good job and can help you with that overall personal finance idea. The problem is, even at a 1%, a lot of advisors, they'll charge 1% a year on your assets, which kind of makes some conflicts of interest as well. But even if they're only charging that, I did a study that 1%, if you're putting in maybe 5,000, 30,000, 5,000 a year, that 1% off of your assets each year, it costs you about 130 grand over 30 years. So it is not minimal, it is not marginal. But I do understand a lot of people don't want the stress of picking stocks. They don't want the stress of managing their own portfolio, even to the point of just just investing in ETFs, just investing in market-wide funds. Just a few Vanguard funds can really give you all the exposure you need and those market returns. If you don't want that, I would suggest maybe going with some of the robo-advisors. And there are great robo-advisors. Basically, these are just websites that do everything a personal financial advisor would do, except it's based on a computer program based on your goals, your age, and your risk tolerance. Basically what these are going to do, they're going to put you in that set of market funds. So they're going to put you in some stock funds, some bond funds, things like that. And they're going to automatically adjust that every couple of years or so, depending on, as you get older and as you get closer to needing those funds. They're very low cost. So you've got things like Betterment, Wealthfront, Wealthsimple, lots of different robo-advisors out there that will basically manage this for maybe about a fifth the cost of a personal financial advisor. So that's an opportunity. Shameless plug here. I've got my investing course actually shows you how to start with your goals. It's like goals-based investing strategy. So it starts you with your goals, figure out what you want, what type of investor you are, and then shows you some of those sector and market funds to basically turn it into a kind of a no stress investing strategy. Right? We're not talking about picking stocks. We're not talking about a lot of these financial ratios. We're just talking about putting you in safety sectors, sectors of the economy, as well as getting your bond exposure, getting your real estate exposure, making it a little bit more stress free. So what else do we have? What do you need for selling off stock, like typically? It's a good question, and I'd like to just refer to the video that I did a few months ago. If you want to look for it on the channel, it's like 5 reasons to sell a stock, and it goes in depth into what every equity analyst looks for when they're making their sell recommendations. And like I said, a lot of it is has management broken that confidence with investors? Has there been accountability for whatever reason is that this stock price came down? A lot of those decisions that you need to make when you go to sell a stock. Nice knife in the background. Thanks. That's my shadow box that you get when you get out of the Marine Corps. I'm pretty sure you get one for getting out of some of the other services, but your rank insignia and then something from your career in the military. And mine was the K-bar. What about notes? Okay, so Jim, you're talking about notes as far as bond notes, or what kind of notes, like treasury notes, investing in those? Not quite sure what you mean there. If I missed your question up there, I want to please ask it again so I can see it. I'm going to go back through one more time real quick to see if I missed any questions. Okay, so got another question. If I believe the Fed will cut interest rates, should I hold off on getting a mortgage on a new house? I mean, we can get into the whole interest rate idea here. Don't necessarily think the Fed is going to cut a whole lot, even if it does. But let's say we think the Fed is going to cut a quarter of a percent by the end of the year, which actually the market is pricing in about 85-90% chance that they're going to make at least one interest rate cut this year, maybe even 2. The thing is, especially if you're making these big financial decisions like getting a mortgage, I mean, a quarter of a point cut in short-term interest rates, which is what the Fed does, might not translate to a whole lot into that 30-year, that 30-year or even 15-year rate. And the reason here is if you follow rates and you've been following them for even the last few years, then there's been kind of a breakdown between long-term rates and short-term rates. Just because the rest of the world, the rest of the especially developed economies like Europe, Japan, their interest rates on long-term rates are less than 0. People in Germany are actually paying the German government to buy 10-year bonds. It's like a negative 0.2%. Okay, so people are actually paying to park their money in 10-year German bonds and losing money because of that negative interest rates. So what that means is, obviously you've got all this money coming in from around the globe into U.S. dollars, U.S. Treasuries, because of that 2.16% yield on the 10-year Treasury. Okay, so that's depressing the long-term rate, holding that long-term rate down, as well as a lot of other economic factors. People looking at a potential recession or economic weakness in the future, while the Fed is raising its short-term rate. Okay, so that typical relationship that we see where, okay, the Fed raises rates on the short term and that pushes up long-term rates. Okay, so yeah, in that instance, if you were looking at a mortgage, then it would be affecting what rates you're getting on the mortgage. Well, since that relationship is broken down, then what you see is, okay, even if the Fed cuts by 0.25%, sometime the rest of the year, it might only translate to a 0.05 or 0.1% change in those longer term rates. So not something that's really going to save you a whole lot of money one way or the other. I would make the decision on something else. So if it's a refinance, then obviously you're still in the house and you're just kind of waiting to see or whatever. But if you're looking to buy a new house or whatever, I'd say it's not going to make a whole lot of difference. So probably not going to make a much of a difference one way or the other. So what else do we have? Any other baby bonds? Where's the bow tie? Yep. Sunday. Come on. You got to give me one day a week where I can take off the bow tie and relax with all of you there. Credit cards, secured credit cards. Some companies suggest for secured credit cards. I really don't. I appreciate the comment or the question, CD. I don't do a whole lot of secured credit cards myself, so I don't know that I could really recommend any in particular, and I don't want to just spout off a few companies and maybe send you to the wrong place. I need to rebuild my credit, can only qualify for secured cards. Yeah, I mean, I would just, generally what you can do, and I know you don't want to have too many inquiries on your credit, like rushing out to try to apply so many credit cards, it can hurt your credit score. But generally, if you do that within 30 days, you get all your applications out and you just see who's going to offer you the best rate. That's going to go on your credit report as one inquiry. Okay, so it's not necessarily going to hurt your credit score too much to rush out to look for a bunch of different companies. What you want to do is obviously you want to look for who's offering you the best interest rate, so the lowest interest rate on your card, as well as any fees they're charging, and just pick the one on the lowest fees and the lowest rate. Okay, but you can go out and look for fill out different applications for different credit cards. If you do it within a month, then those are going to be one inquiry on your credit report, and it's not going to hurt you so much. What else? Nisu, I'm sorry if I mispronounced your name there. I recommend crypto. Actually, at this point, it's hard to say. I haven't looked at the numbers yet. Actually, about a year ago, I had a video where I did recommend crypto and Bitcoins actually specifically, and I showed you a way to value Bitcoin, to actually see a fair value for it. And it's called there's a natural law that somebody is wrote about, or a theory that helps you, that works for all social networks. It can work for valuing Facebook stock, for Twitter stock, any company, any stock that runs on a social network like Bitcoin. Then you can use that to value it. And I actually used it. Came up with kind of a fair value around 4,000, 5,000, somewhere around there. So I did recommend, maybe putting a little bit more money in there. Now that it's at right around 8,000, 9,000 per Bitcoin, so a really nice profit over the last year. But at this point, I think you got to be a little bit more concerned about the actual value in that and what you want as an investment. So I wouldn't necessarily not recommend Bitcoin, but I definitely wouldn't put too much into it. Maybe 5% of your money. If it goes up, up to 20,000 like it was, then you've made some good money. If it comes down more, then you haven't lost too much of your portfolio, and you're not quite freaking out there. How many stocks do you personally hold in your portfolio? Which one's your strongest conviction? I hold, and I'd have to check because I've got. I mean, you got to understand. I trade on 5 different platforms, and a lot of this is just one platform. So M1 Finance gives me no cost investing. So I love using that for our dividend stock portfolio challenge. I use E-Trade and Bank of America Merrill Lynch for the research. I get access to Credit Suisse reports, Morningstar reports. I get B of A Merrill Lynch reports. So I use those. I use Ally Invest for that overall financial banking and all that. So I've got different stocks in all of those. I'd say I do use the core satellite approach, where I have about 60% of my money in funds. Okay, so just broad-based funds gives me that market-wide, that market return, and I can juice that a little bit by holding different sectors instead of just the overall market. And then I use about 35% of my portfolio is in individual stocks, and that's the stock portfolio. But I'd say I probably hold about 22 individual stocks. Normally, I would suggest holding maybe 10 or 15 at the most, because you do need to do this financial ratio analysis that we talked about for each stock within a sector or industry that you're looking at to pick the best ones, and you need to do that analysis. You need to keep up with it. So that's very hard to do for anything more than 10 or 15 stocks. Now the reason why I hold a little bit more is because this last January I added our 10 stocks into our dividend stock portfolio, so that was an extra 10. Some of which I own in my other portfolios, but some of which I don't. So my maybe 25 is a little on the high side. I would say pick 10 or 15 stocks that you really like. You really think they have strong competitive advantage, and you're willing to follow them and understand that business model, and then just put the rest in ETFs. Which one is your strongest conviction? And I'd have to look through some of these. One that is very risky, and I've talked about it a few months ago, actually, in a penny stock video, is EGO, Eldorado Gold. And the reason why I like this stock, I've actually been following it for a couple of years, but just increased, not too long ago, increased my position. Great gold miner, and so you've got the macro economy where you're looking at, gold prices are a little bit of a safety hedge against the stock market. Doing well, except that the dollar's been on a tear lately, so that's kind of depressed gold prices. So you get that macro theory that gold prices are going to be higher, going to support these gold miners. But also Eldorado is just very, very depressed stock price because of some of the company-specific problems they've been having. They've actually got a lot of their production in Greece. And actually have had fights have been fighting for the last few years with the Greek government, the Syriza party, about getting the permits that they need. They won a court case that the Greek government has to give them their permits for that production, and the Greek government has continued to shuffle its feet. So it's really hurt the stock price, really hurt the company. Well, these last round of European elections we had just this last month. Looking like definitely going to be a change of government in Greece. They're having snap elections on July 7th that is probably going to bring in a conservative, business-friendly government. And what we saw the price, the Eldorado shares jumped about 15% on the day, the Monday after those weekend elections. So definitely something that is an upside for this stock, and it's one that I own quite a bit of money in. So that is a pretty strong conviction, but is a very risky stock. So I don't want everybody. I want you, if you're not just taking my word for it. You're going out there. You're looking at this stock against other gold miners, whether you want gold miners at all in your portfolio, and you make that decision on some of the ratios that we talked about here. Okay, that guy. I'm looking to transition from the military into the financial sector. Where would you recommend start looking? I hear investment banking is typically the best place. Investment banking is great if you can get it. I mean, that's that 6- and 7-figure payday. So yeah, I mean, I would. A lot of these, they're going to need some kind of a degree, and they're going to want experience. I would recommend, and maybe I'm a little bit biased because I hold the designation, but I'd recommend looking at this Chartered Financial Analyst designation. Start reading that, and even if you don't go for the designation itself, start reading the curriculum. That's going to give you everything you need as far as corporate financial analysis, equity analysis, a lot of things to start looking at. As far as where to find it, what part of the sector to look at, I mean that's really going to be up to you as far as looking at the different jobs and different roles available and what really fits you. Because the worst thing you could do is take a job just for the money and be miserable for a third of your life, right? I think a mistake that almost all of us make at one point or the other. You got to be happy with your job. You got to do something you enjoy. You got to be passionate about it, or you're never going to do well, and it's never going to be enough money to sacrifice a third of your life. Good question though. Does Merrill Lynch allow you access to Morningstar, or was that Fidelity that allows? Okay, Merrill Lynch feel like. Okay, I mean, for Morningstar, I've got a premium account on Morningstar anyway, just because I use it so much as an equity analyst, and I'm so familiar with it, and it's some really good, really good financial data and stuff like that. So I've got a Morningstar premium account anyway, so I really don't use just the research that I get on a lot of other things. I know E-Trade gives you access to the Morningstar reports. So if a Morningstar analyst covers a specific company, you'll find that report specifically available on E-Trade for free. You won't get a lot of the other financial data that you get directly from a Morningstar account. The silver price is, I really don't follow silver very much. There are relationships you can make with gold. So if gold is depressed, then silver is probably depressed too. I think gold is waiting for its day and could be higher for the rest of the year, especially on the macro developments that we're seeing. But also, eventually, if we see some dollar weakness, then gold will go higher, and that's going to take silver up with it as well. If you had 120,000 in a retirement IRA, age 6 became disabled, how would you invest it? Oh man, I'd love to answer your question here, but that's a big question. I mean, that's first of all, you've got your goals. So how much you need to invest, or how much you need to produce from that. So a monthly income to produce from that money. Your investor type, which is how freaked out, how stressed out you get from ups and downs in the portfolio. A lot of different things that we need to talk about on that. I don't want to shamelessly plug my course, but that's exactly what that does. It starts you with your goals, starts you with finding out exactly how much money you need, your risk tolerance, and actually in that I do share 3 retirement investing strategies that that you can use to make your money last a little longer, like the bucket strategy, laddering with bonds to make your money last a little bit longer. Again, I've shared a link in the description below for a 45% discount that I only offer to the people in the YouTube community here, as well as a free webinar that will actually go through most of it with you. 99% of it is in that free webinar. If you want to check that out, the course is just for people that want a little bit more hands-on and maybe that direct portfolio review. So with that, I think, I appreciate everybody being here. We went a little bit longer this week than I had planned, but like I said, I love this kind of back-to-back community interaction. Check out some of those other videos that I mentioned in there. Check out our 2019 Stock Market Challenge portfolio. We're going to be updating that this week on Wednesday. Again, 18% returns versus a 9.8% return on the stock market so far this year, so doing great in the portfolio. If you've got any questions that I didn't get to, just go ahead and ask them in the comment section below. Going to take about an hour to process this video, but then it'll go on the channel as a regular video, and you can just ask your questions there. Again, Sundays at 1 p.m. Eastern, 10 a.m. Pacific. I love talking to everybody here, and I appreciate your time. I appreciate you showing up. And until next Sunday, I will see you then.